For all verified facts, subscribe to our YouTube channel and click the bell icon to get the latest updates.
Hello and welcome to From the Front Lines. The question we are asking today is, why do companies or businesses really want to set up banks? Now, this issue came forth after a note released by the former Reserve Bank Governor Dr. Raghuram Rajan and former Deputy Governor Viral Acharya, which called it a bombshell and said that this proposal is best left on the shelf. The proposal they were referring to came from a Reserve Bank of India internal working group that had a view that large companies or business houses or industrial houses should be allowed to promote a bank. And therein lies the nub of the issue. To understand why this proposal came up, but more importantly, why do businesses want, and can they actually pull out all that money that could be lying in a bank into other businesses and therefore trigger the concerns that have been triggered? To discuss this, I'm joined by Ashvin Parekh, Managing Partner of Ashvin Parekh Advisory Services, a veteran consulting and consultant in the banking and financial space, earlier with Ernst & Young, and also joined by Roongta, CEO of Only Investment Advisers, also once a banker and an investment advisor for many years. Thank you both for joining me. Mr. Parekh, let me begin with you. So first question is really from the other side. Why would a business house want to set up a bank?
Yeah, so this is interesting. See, I mean, way back in 1992, when the first set of licenses were going to be issued, I had done about 5 applications. 4 of them were from financial conglomerates. I mean, some of them were development financial institutions, and they wanted to migrate into, organizations like RBI, UTI. So I did those applications at that point in time. One of the applications was an industrial house. And even though the regulations at that point in time weren't too clear about whether corporate houses or business houses, that time it was called industrial houses, by the RBI nomenclature, I'm saying, whether they would be allowed or otherwise. It didn't come through, of course. The other 4 came through. The other 4 approvals came through from the RBI. Then in 2001 period also, once again, when they were once again going to reopen that subject, I did about 3 applications, one of them from a financial conglomerate and 2 of them from the business houses. And as back as 2012, I did almost about 8 applications out of 24 overall applications for a universal bank. Only one of them materialized. That's the IDFC one. But then the others included business houses and NBFCs, also large NBFCs. Why do businesses, why would they look at a bank or setting up a banking company? See, banking business in India, I always sort of subscribe to this view that A, it is very difficult, highly regulated, and B, the cyclical problems, the economic cyclical problems do have a huge amount of impact, on a banking company. So, I've come to one sort of observation. This is something, after working in 5 other jurisdictions, yeah. 5 other countries, that if you are in a position to put up a large-sized bank, if you are a good industrial house with a very good, let's say, compliance and governance record, and if you really do put up a very large bank, through organic or inorganic measures, but if you do put up, then I suppose you are okay from the point of view of returns. By and large, a universal bank today with 500 crores, which was the earlier sort of, threshold capital, you are still breaking in after 4.5 to 5 years. So banking business from the point of view of, let's say, hardcore returns is not as lucrative as people may perhaps think about. But that's when this recommendation has been made by the RBI. I would just say that, look, the idea was to look at very large corporates and not the mid-size and the small size, basically. But yeah, I think it's more of sort of getting into a banking kind of business rather than being a profitable venture at all.
Right. Okay. So we'll come back to that point that you raised. Mr. Roongta, why do you feel that businesses want to set up banks? So I know I'm not coming onto the regulation part and why they should not be allowed, and that's a separate discussion which we'll touch upon. But why would businesses want to set up a bank to start with, if indeed it's difficult or challenging, as Mr. Parekh points out?
So I don't think any business is easy in India. Setting up a business and running a large scale business is not easy. But in a banking business or any financing business, your raw material is money, right? Uh, Getting that raw material, I don't think is a problem, as is attested to by, I mean, the number of people and the kind of people who are able to raise large sums of money from the lay public. I think we have all seen that, happen. Uh, I think it is the cost that makes a difference. It is the respectability that makes a difference. I mean, after the nationalization, or probably prior to that as well, but after the nationalization in the late 60s, I think 69, if I'm not mistaken, except for cooperative banks, we have not had a failure where depositors have lost money. So, I mean, the Reserve Bank has stepped in and has sort of, made sure that the depositors didn't lose money. And because of that respectability, your ability to access raw material, which is money, at a very reasonable cost becomes high. Uh, you are able to raise that money, as is attested to by the number of scams that have happened. But that normally comes at a high cost, much more effort. When you are a bank, properly licensed bank, it comes at a much economical cost. I think it's a simple matter: cost, respectability.
Right, but on the cost part, now how would it matter? Assuming, let's say, all the other ring fencing guidelines and regulations are strong, which means that even if you own a bank, there's no way any of that money or the money that you've taken from depositors can go to any of your own other businesses. Then why would that cost matter or make any difference?
So, I mean, look at the NBFCs. I mean, who are going to be the first people? And I think that was also made, some comments have come that the large NBFCs today, they are borrowing from the banks. So, I mean, when they borrow from the banks, obviously the bank has a markup on that. I mean, I'm just making it extremely simple, right? If they were to directly take that from the public, and the bank is running similar risks. I mean, that's why you have systemically important NBFCs on which RBI's regulation and supervision is much, much higher. I mean, they are as important as the banks. And then it's very reasonable to expect that those NBFCs would want to move down and start raising that money themselves rather than raising it through the bank and paying a margin to the bank. I think it sounds logical. This is not a comment on what can go wrong. I mean, this is just a comment on why they want to do it.
Right. So, Mr. Parekh, let me come back to you. So, one is the traditional model, and you talked about why many, or you did indeed put in applications on behalf of many business houses, and most of them did not get through. So one is the traditional model of a large bank and so on. And then there could be the newer models, which is more recent. And maybe the lobbying intensity or the interest is a little different this time because it could be, riding on a layer of fintech. It could be to do with, the small bank. It could be to do with payments bank and so on and so forth. So do you feel that the reasons this time are different from maybe what they were a decade ago?
See, the reasons, what we're talking about are I mean, let's just analyze them. One is, let's say, the banking services, the product and services. The other is the delivery mechanism. Now, what you're touching upon is the delivery mechanism. That is, let's say the whole banking system, the delivery of banking services and products, that has undergone a radical change. And thanks to COVID now, it's going even further dramatic changes. But does it really change the very core nature of the products and the services? I don't think so. Let me articulate my point. Let's say if you are in lending business, for example, whether you lend through, let's say, a fintech kind of a platform, or you lend through, at the end of it, there is a borrower and a lender relationship. And then borrower, depending upon, I mean, even when he has the intention of repaying back to the lender, he has his own economic sort of, an external environment to really worry about. And which is what we saw in case of, let's say, auto industry, for example. 4 years ago, 3 years ago, 2 years ago, it was going through a bit of a patch because the economy wasn't performing as well as it was expected. And then suddenly now after COVID, we find a different thing altogether. But who suffers at the end? Or, I mean, at the end of it, the lender still, the relationship, irrespective of platforms and technology, the working remains the same. I suppose, when we talk about differentiated banking, and this is something I have always found. In fact, I personally believe that the whole experiment of differentiated banking has not taken roots in this country at all. 9 payment bank applications, 9 approvals were given. About 9 small finance bank approvals were given. For small finance bank, this is too small an experiment to really arrive at any judgment. But differentiated banking, did it find roots in India? I don't think so. I mean, out of 9 applications, only 2 of them are in, one of them is in a proper shape. The other one is struggling to be in a good shape. And some of those who got the approval and started the payments banks want to become small finance banks, and now there are regulators trying to pave a way for that. So it's a little complex thing, but I would still believe that where the economic volatility, the economic performance volatility is high, in that backdrop, a universal banking model is a much better model compared to a differentiated banking. The technology part, time and again we have seen, we saw, 2 or 3 prominent private sector banks were at the upper end of technology at one point in time. The cost of, let's say, their operations were far, they were benchmarked even by global banks for that matter. But did that advantage continue? I don't think so. So, I would say per se the products and the delivery mechanisms have to be distinguished quite clearly.
Okay, right. So that's a strategy that they may adopt or should be adopting. So let me pose the same question that I started with a little differently. Now, when we talk about the proposal of industrial houses and business houses, that really or typically brings to mind conglomerates. Or large groups. It could be the Tatas, Birlas. Some of them used to have banks once upon a time and now obviously don't, or Reliance. Now, one argument could be, and it's me who's posing it. Suppose you had an automobile company or you had a large consumer durables company, then you need a finance company or a bank which might help you in financing products or services for your consumer. And that may have been done or is being done through the non-bank finance route. Maybe or potentially a bank could add value there. So there is no direct benefit in terms of borrowing from that bank or that you will divert money from depositor money from the bank to other group companies. But surely you may ease the delivery or ease the selling of products and services by those companies. So could that be a reason why some businesses, houses or conglomerates who particularly have large consumer facing businesses are looking at banks?
Well, let's look at it this way. You see, there is this aspect of concentration of risk. So, and then if something like this were to be one of the reasons why, let's say a large retail customer facing kind of a conglomerate could be looking at a banking company, to my mind, the regulator should be more wary or should be careful about such an application. And the reason is very simple. You see, you're still keeping the risk somewhere within your own balance sheet. In fact, you could have given credit to your customers for that matter. In the normal course of your business activity, you're bringing that to the bank, And this is exactly, what you touched upon is actually, you hit the nail, on its very head. Where will the regulator draw a distinction in saying, is there an arm's length kind of a relationship between borrowers and the promoters of the bank? It's going to be really difficult to my mind. Because where do you end? How much of due diligence can you really conduct, on some of these things?
Right. So, Mr. Roongta, if I were to then ask you to look at it even more plainly, is a bank just another business? As India liberalized and in some ways continues to liberalize, and maybe there are more reforms and more businesses get opened up, you just want to diversify your overall basket of businesses, and being in finance and in finance bank is a holy grail of sorts, is a good thing to have. Is that in some ways the driving motivation for many of these business houses who want to get into banks?
Yeah, as I said, they need resources. The resources could be for their own use. The resources could be for use by their their suppliers, or resources could be for use of their consumers. And today also this is working, right? Banks have tie-ups with I mean, every auto company would have tie-ups with a series of banks.
Right.
And they are able to sell their products. They have tie-ups with all the top marketplaces, all the e-com places have tie-ups with banks who then fund the suppliers to those marketplaces. So I don't think that this is missing today. This is happening today. The advantage, disadvantage is that it is independent of the person manufacturing or providing that service, which is being funded by a third party. So there is a independent appraisal of the credit quality. When you have a captive finance, and in fact, every big consumer durable company has a captive NBFC sort of an arm. The only issue with the captive is, as Mr. Parekh says, the job of the captive is to say, sell my product. Okay. So whether good or bad, some of the risk of the product failure gets passed on to the financier. Where it is captive, that risk obviously tends to get concentrated because a third party independent may not take that risk. Okay. But captive will have to take that risk because that is the reason why it is in existence. So I think, yes, banking is like any other business, but it's a very vital business. It's a highway, and I think you can't afford to have your highway choked up.
Okay. Mr. Parekh, let me put that question back to you. Many business houses are sometimes quite agnostic to the businesses. I mean, they as they grow as a large conglomerate, they have let's say their hand in, or their fingers in, maybe it may be cement, it may be steel, infrastructure, roads, airports, and maybe energy, and then why not banking also? So is it that motivation which drives the quest for a bank? Or is there some icing on the proverbial cake which we are not quite sure about?
Yeah, so that's a good question. I mean, even I analyze this regularly. So looking at my own experience, I thought way back in the 90s until about 2000, till about 2010, I would say, there was a certain amount of psychological sort of built up within our industrial houses, business houses and businesses per se. I mean, I would describe as a herd mentality or a club mentality, in the sense the minute you are in some kind of a, let's say, corporate club, and then you find that someone is really thinking of putting up a bank, and the first question that would arise to you is, look, I mean, am I not well diversified? Am I not as largely reputed as the other person is? I mean, it's very difficult for someone to admit that, let's say, the reputation or the diversity or the quality of the financial strength of, let's say, or the overall financial strength of that conglomerate may be any shade different from the others. I mean, we all start believing that we are sort of, saints in our own rights. And then it becomes difficult. I mean, everybody wants to really jump in for that kind of so license Raj sort of kind of an approach may perhaps have played its role when it came to the applications. But on the other hand, just to complete my thought, I suppose the on-tap universal banking kind of licenses, which was actually, it started in 2016 and the guidelines were refined in 2018. But we did not have, people applying, for many people, the financial conglomerate. Those who had 10 years of financial experience, let's say, and then not the business houses, not the corporate houses, of course. But even they didn't apply for universal banks. So, if there must have been a reason. I mean, that so-called herd, mentality or the herd sentiments, those have changed, looks like. I mean, people are now more careful with a large number of failures that happen in businesses. And if that really prevails, then there may not be floodgate of applications. I mean, to answer that part of the question.
Right. And you mentioned a good point. I mean, that someone may just want a license. I mean, you use the word license because it's a license, and it's you may set it up only with the intention of selling it to a larger player and so on, almost like a venture capital investment, and your returns could be good in a very short while. So that could be another fairly good reason for someone to want to set up a bank. So last question to both of you, and let me begin with you, Mr. Roongta. So now we've tried to look at it from the business side. Why would a business want to set up? Now, this question, of course, has been asked, but let me pose this to both of you. From the regulator side, should they be should a bank have a private owner, or differently put, should businesses be allowed to own banks, or should businesses be now allowed to own banks, particularly at a time like this?
So I think it is some of these risks that the banks are running, we have seen them visit, we have seen them happening. I think the fear is that the standards that we have, the general corporate governance standards that we have, it does not inspire much confidence, and I think rightly so, as is attested by the fact of so many of these things regularly mentioned in the headlines.
Right.
I think that lack of confidence is the issue, and also the fact that internationally also there seems to be generally a frown on industrial, large conglomerates owning banks. I think there generally is not something that is the environment is not very friendly to that. So I think there is also a lack of precedence, and very clearly, also probably what we see today is a start of a process. It's an internal working group's recommendation. I think it takes time. So I think it's good to have this debate. I think that I don't think we can have an answer at the end of the debate, but it is good to have this debate so that these issues can be thrashed out.
Right, and it a debate that becomes particularly interesting when you have a former governor and a recent former governor and a deputy governor weighing in with full force. Mr. Parekh, last word to you. From the other side, should a regulator be concerned, or is this environment really ready for business houses to own banks?
Yeah, see, that's a very interesting question. See, the internal group set up by the RBI, the expert committee set up by, internal set up, have made this recommendation. And Harsh rightly said, it's not regulation, it's not law as yet. Sure. By any means, but there will be comments and there will be other filtrations, and a lot of regulations also need to be changed, to really do this. What could be the reason why, let's say, the committee has made such a recommendation? If capital is the requirement, that is, if there is a feeling, an impression, and rightly so, that there is a dearth of capital, and there is going to be even that capital constraint may continue because public sector banking are not going to get the kind of dosage of capital that they actually do require. In which case, let's say, more private sector banks will have to be really opened up, more capital will have to go into the existing private sector banks. So if that is the thought process, to make sure that there is much more of resource available, capital available to the Indian banking, to make sure that there is a credit flow, and part of the Atmanirbhar program and manufacturing program and so many other things, then I suppose it's a thought that's worthy of debate. Right. I would certainly put it that way. But at the same time, I think before the gates are opened, the gatekeeper will have to really work out very clear norms, to make sure that only the correct candidates can get admitted. Right. And the last bit, governments come and governments go, sort of, and different governments look at the regulations and with different perspectives. So it shouldn't happen that, let's say, we start with something and then 10 years down the road or even earlier, we start realizing that, we were better off by keeping the gates closed and, we unnecessarily opened them up. So to that extent, the onus will go back to the regulator. The committee has done its work, but the onus will go back to the regulator in ensuring, because banking is trust, And if there has been no failure of any Indian banking, then I know the amount of effort, an honest effort our regulator has put into to ensure that. Now, should it really make himself more exposed to, let's say, working hard to keep on doing that, is a matter of discussion worthy of further debate, I would say.
Right. So protect everyone inside the gate rather than open the gates and get new people in and then expose everyone. Mr. Parekh joining us from London and Mr. Roongta from Mumbai. Thank you both for joining me and sharing your thoughts. It's been wonderful talking to you.
Thank you.